Hey, it's Ryan from the Option Income Advisor, and this is the trade of the day for August 5th, 2021. And so, this is an interesting stock. It's another stock that may come up on your list from time to time, but it's not a stock that ranks really well from a safety perspective. And I'm talking about GM. And if you watched it today, obviously it sold off quite a bit, and it actually had reported pretty good earnings. It raised its guidance for the year, but there's so many supply chain issues right now that it was just too much for investors to look past. Rightly so over the short term, right? And when you can't get components to make your vehicles, even though that there's really, really high demand still for new vehicles, they can't get enough parts to make their vehicles, which is obviously frustrating. And this comes at a time when they're spending a lot of CapEx still on electronic vehicles and things like that. I mean, they've got a policy that they're going to spend $35 billion between now and the end of 2025. So, I mean, they're definitely dedicated to it. That's the way the market's moving. But this supply chain issue has just come at a bad time. So I think the future's bright, for a stock like this. But we'll get into kind of look at the numbers a little bit. I think it makes a great play for the triple income wheel. So it's like, what do you do when you've got a stock that's and there's some funny puns you can make with this stock in particular, but a stock that's stuck in neutral. Is there any gas left in the tank here? I think that's the title of the video, but there's a way to generate a dividend or create a dividend on stocks that are sitting there that don't necessarily come up on your dividend screens, right? And so this is a perfect example of that. It's a very liquid stock. And obviously this is a good time to get right into the stock profile here. But so the stock sold off 9% yesterday. So this is a good entry point, hopefully for an investor that's wanting to get in. But again, the fact that it sold off after reporting good news, I mean, I think you've got a situation here where it literally could be stuck here until it reports some kind of catalyst that has turned the tides for investors, and until the supply chain fixes itself, which is not a quick issue, and I think that's why the stock sold off. It's basically investors getting out saying, well, I'm just going to wait. Yes, the future may look bright, but I'm just going to go ahead and wait. And so if you're a new investor, though, it offers a really good opportunity to get into a stock like this where you can give yourself a margin of safety. You can manufacture your own dividend. A lot of times in the 1% plus per month, 12% annualized return, which is a phenomenal, return over the course of the year. But we've got a situation here where it's a stock now that I think probably has some limited downside because we've already got the sell-off, right? I mean, the stock is off. I mean, we're 18% below its recent high, and it's kind of hovering around some points where I'll show you in the chart that I just think we're probably in a situation where maybe there's a couple dollars of downside, but I think there is upside in the future if we were to purchase it at that price. So the strike zone we're looking at here is 47 to 49. So the stock's right around 43. So this is still giving us, even the high end of the strike zone, this is still giving us, about a $4, cushion, but before buying the stock. So this is an attractive situation, I think, on a stock that has, I believe, some good long-term potential. So again, Safety ranks pretty low. So again, if you've got a safety filter in your in your screener, this stock would get kicked out. And so this is one that may have to come up on a different screen of yours, say a value screen, because it obviously has the highest value ranking right now. So that's pretty enticing in itself, right? Because, obviously all else being equal, if we can if we can write a put on a stock that's already trading at a good value, it makes you feel that much more comfortable. And so that's a situation I think that we're in here with GM. And it's, it's got a reasonable required margin of safety. Again, it's probably an average volatility stock from kind of a risk perspective, and you can see it ranks right kind of in the middle of our rankings with a 5. We do have that pullback indicator of 9, which again just kind of signifies that we've already had quite a big pullback, so we don't really need that extra margin of safety there, because we've already pulled back quite a bit, and obviously it did just report earnings, so we don't really have to worry about that going forward either. Very liquid stock, very liquid options, so it makes sense for a triple income wheel situation. So if this isn't on your watch list, click that add to watch list button, because you do want this on your watch list, as you're watching for good cash secured put opportunities. But I think it warrants, look right now, obviously just right after the sell-off. So let's take a quick look at the chart. And so, this is a stock that's been in an uptrend, and you can see where I kind of set the parameters here so that you could see the pandemic low, right? So this stock hit about $17, a little under $17 at the low, and then we've kind of been in a very, very nice uptrend since. We've had some ups and downs here and there, but for the most part, you can see a very strong uptrend with that 50-day, that blue line above the 200-day. And so I like that, but what's happening here now is we've kind of peaked. We're up around $64 a share, and now we've come down a bit, right? And so we broke through the 50-day moving average, which happens. I mean, the main one you want to worry about here is the 200-day, that slower moving average. And so that's kind of a level to watch. I could also see us again just kind of creating our own little range here between this peak, and I think probably after this breakout, this dotted line is the breakout, right? So this stock broke out kind of early this year, this kind of through this $46.50 level, and kind of kept moving higher. So basically went from 46.5 all the way up to 64. And so that breakout level tends to be a pretty good support level on the way down. I don't even know if we get there. I would think even this low. So after the breakout, the low that we saw was right around 50, right? And so I think that low of 50, it's just below this 200-day, which is 52. So between 50 and 52, I think you're going to probably see some good support. If we drop down below that, again, I think 46.5 is probably pretty good support there. But I could definitely see this thing just trading in a range for the better part of 3 or 4 months until the next earnings call, until we get more information or we get any kind of catalyst or news on the supply chain. And so that's kind of where we are. So I think there are some good levels of support, and I think it again correlates pretty well with our strike zone, which is what we want to see, right? So let's take a look now at just valuation. So this is a stock that's always traded at a low valuation, so kind of take this with a little bit of a grain of salt. But anytime you can find a stock that's trading at a PE below 10, sometimes there are value traps, but it's not like this is trading in a crazy valuation level, and you're asked to kind of take a flyer on electronic vehicle production, things like that. I mean, this is trading at a very low multiple. Part of it is it's a high capex business. This company has a lot of debt. That's why we have a safety rating of 2, as I'll kind of highlight here in a second as well. So there's some fundamental financial reasons why, this stock probably trades at a low valuation. But again, when you're at, 7.5 times of, your forward multiple, it's pretty attractive, or a half-time sales. I mean, you won't find too many half-time sale companies out there, especially with this kind of upside. I think there are, there's definitely some upside. I think with a stock like this as well. So that's kind of what we're looking at from a valuation perspective. That's why it has a value ranking of 10. It just definitely trades at a low valuation, and it historically has. But I think it's pretty attractive right now. Based on some of the upside I think we see. And so, this stock, it's not been a pretty trend. This is kind of almost what you would expect out of an auto manufacturer. I mean, you see sales and EPS just over the last, actually, let me get this here. Sales and EPS over the last, several years has just kind of been in a downtrend until we hit this nice pocket with the pandemic, right? I mean, we had this high demand, once the pandemic hit for vehicles. People were staying at home. They were just traveling a lot more with vehicles. They wanted to upgrade their vehicles. And so a lot of, and at the same time, the supply chain shut down. So they were able to rip through all their inventory. And if you've driven by a dealership lately, you know what I'm talking about. I mean, there's hardly any cars on the lots, which is pretty crazy to see. So the question is, we've had this pop. Now we're they're projecting about $7 a share in earnings. Can we stabilize at that level? Or our earnings going to fall off again? So that's kind of some of the questions and uncertainty that kind of remain there, and so that's what we'll be watching. But not great charts by any means. I mean, we've seen some good charts with with some of the some of these higher growth names that we've been looking at recently. But again, there's no exact recipe for a good triple income wheel stock, and that's kind of why that's why I do these trades of the day, just to give you a broad subset of things to look at, because it's just because a stock doesn't meet a certain criteria, there's no perfect stock, is what I'm trying to say, right? There's things that you kind of got to peel back the onion a little bit on all these stocks, and I think that if you can find a good balance there, like I think we have here with GM, where maybe from a fundamental standpoint it doesn't look great, especially with the trends, but we've got this longer term kind of qualitative reasoning behind wanting to be in the stock, right? Which is, hey, these guys' goal, the goal that GM has is to be the number one, have the number one market share in electronic vehicles by 2025. And if you think about all these different vehicles, I mean, you're talking about, Chevy, Silverado trucks. I mean, some very, very popular, brands. They've got if you haven't seen it, the Cadillac Lyriq all electronic SUV thing looks amazing, right? So they've got some really cool products coming out, and I think it's that they're going to make a move for sure. So I think there's some definite upside here, and so that's the kind of stuff we look for, right? A situation where we've had a pullback in a stock, we can have a little bit of extra margin of safety even if we're not right. And if we can generate, 12% annualized returns on a stock that, hey, we would hold over the long term if we had to, it's a perfect situation, right? So always peel back the onion on stocks. When you see a few things you like, peel back the onion to see if it makes sense. And again, that's why I always tell everyone, you got to have multiple screeners. You have to have multiple ways to find stocks to peel back the onion on, right? You got to have that master watch list that you're creating at all times, stocks that are meeting certain criteria for you, because that way you've always got that well to go back to look to see, hey, is this a stock that makes sense? And quite frankly, before this stock sold off 9%, I don't know that I was that interested or would have pulled the trigger on a cash secured put. But now that it's pulled back 9%, now we're in that situation, that sweet spot where I think, hey, this could make sense now, because from a valuation perspective, it makes sense. It's pulled back. We can give ourselves another margin of safety and just feel pretty good about it, right? So let's go ahead and look at the cash secured puts. And again, we're looking at September now. September 17th is the monthly. So let's take a look at a few of these. And so EPS risk is still showing up. That's just because it reported today. But we know that there is no EPS risk. So when you're looking at that line here, kind of ignore that. But we're going to focus on some of these options that are in the strike zone, right? We want it in the strike zone if we can. And so for our base, we're looking, right around, 1%. So we've got a couple here. And the nice thing about, again, a liquid stock is, here's a stock that we have dollar increments. So this really helps us manage our risk reward when we're looking at these options. So, there is this 47 here, which is the low end of our strike zone, which is 1%. And then we've got the 48 at 1.2%. So really looking at those, those are pretty comparable in my mind. And knowing we have that, I think that $52 level, which was the 200-day, and then we've got the low from earlier this year of 50. This 48 makes me feel pretty good about it. So, I don't think we're getting much more kind of cushion just for that extra, dollar. You still got a 9% margin of safety here. You still have a delta around 20. So actually, I'll take the little extra average monthly yield for this one, especially knowing we don't have earnings risk. We know the stock's already kind of pulled back a little bit. So I like this. I like this risk reward here. So I would say this 48 would be our base. So we got that 1.2% with a 9% margin of safety. And then, for our aggressive, I would probably go up to this 50. Again, I think that 50 level could potentially still hold, which I like the risk reward there for the aggressive side if you're being aggressive, right? So that's right around 2% average monthly yield. You've got the still got a 5% margin of safety and about a 30 delta, which is always good for the aggressive side. And then for the conservative, I would go between probably this 45 and this 46. Again, if you're on the conservative end, this one still gives us over 0.5%, which is kind of our target on the conservative side. So almost about a 15% margin of safety, and then a delta around 10, right? So I like that risk reward there. So this is a situation where it came up on our screen because of the pullback. And so we knew, look, this is a stock that hopefully was already on our watch list. If not, you add it to your watch list. But it's a stock that's come up, it's pulled back, it's offering some really good risk reward outside of having to take earnings risk, right? Because we already just went through that. We're giving ourselves an additional margin of safety beyond the 9% it's already pulled back. We like the long-term perspective of the stock. I think it's a no-brainer. I think if we can just hang out here for 12 months and have this stock just bounce around, a couple dollars up, couple dollars down, we're going to make, 12, 14%, annualized by just, rinsing and repeating the triple income wheel. So that's why, again, this is why it's attractive. And hopefully these are helpful for you. I'm trying to get a broad spectrum of just different stocks to look at, so you can just again get that perspective of when to peel back the onion on certain areas, and when a stock is attractive and why it's attractive. So that's all I have for the day. Take care.